Today's episode is brought to you by Mazars. Sound Cartel. Are you somebody who has perhaps not maximised their superannuation contributions in recent years? Are you taking advantage of your potential $27,500 of tax-deductible superannuation contributions? Well, you can now boost your tax-deductible super contributions from the unused contributions of prior years, so long as you meet the right conditions. From Sound Cartel, I'm Nicole Goodman, and this is Business Essentials Daily. Many of us may not realise that we can now make significant tax-deductible super contributions if we have extra cash available and not too much super already, says Joel Orbita, Senior Manager at Mazars Australia. For example, this strategy could take the sting out of capital gains tax on asset sales. Joel starts by explaining to Jeff Waters how the regulations work.
We have a lot of clients that ask us how they can increase their superannuation balance, and it's a fair question. And for some people, I've got a really interesting answer. There have been some recent changes in superannuation law, and what it means is that if you have a total superannuation balance of less than $500,000, you're now able to boost your superannuation savings while being able to claim a tax deduction.
How does that work?
Well, before I talk about how these changes work, it's important to remember that when we talk about claiming a tax deduction for superannuation contributions, we're referring to concessional contributions. So these are amounts that are generally made up of employee contributions, but they can also be personal contributions that are made by the member, such as yourself. So the first step is to have a look back at concessional superannuation contributions that you've made in prior financial years. The difference between what was actually contributed and the concessional contributions cap can be considered as an unused portion. Now, this unused portion can be carried forward for a period of up to 5 financial years and then contributed as a large lump sum. So you can make a personal concessional contribution significantly above the normal concessional contribution cap by using the unused portion from prior years.
So at the moment, the government allows you, $27,500?
Yes, currently it's $27,500. It's recently changed. It was $25,000 the year before.
So if I don't make a total of $27,500 contribution and it's backdated over 5 years, and I assume obviously before then it'll be $25,000 cap before this year, then the amount that I have not contributed can be accrued.
It can be, yes. It's best to talk to your accountant and get in touch with them to have a chat about it, because it's a recent change. So it's only come in from 1 July 2018. So at this point in time, we haven't really ticked over that full 5 years yet. So as I said, best to have a chat to your accountant so they can best help you determine how you can take advantage of this change.
So who can benefit from this?
Well, firstly, you need to have sufficient cash to make the contribution and have less than $500,000 in super. They're the first things to think about. But in terms of being able to benefit, for example, if you are in a situation where you've made minimal superannuation contributions in previous years, and for example, you've sold an asset and made a significant capital gain in the current financial year, you could utilise the unused portion of your concessional contribution amounts that are funded from the proceeds of this sale and claim a tax deduction against your assessable income.
So that takes the sting out of capital gains tax?
It does. It can reduce the amount of taxable income for that year. So, yes, as I said, best to talk to your accountant as to how they can work that out and maximise it for you.
But you do have to have that lump sum to be able to contribute in the first place.
Yeah, so looking back at the past few years, at that unused portion, is important to make sure that you're available to use that in the first place, and then having the cash to put that in while considering your $500,000 superannuation balance as well is needed to ensure that you can do this.
Are there many people out there, do you think, that would fit into this category?
There are. I think there'll be a lot of people there who, for example, may not have contributed a lot. They may have run their own businesses previously and not contributed themselves to super. So they may have some cash available to make this sort of contribution and still have that less than $500,000 super balance.
Sounds like there are big savings to be made.
Yes, potentially there are.
So how important is the timing for this?
Timing is very important because you need to give yourself enough room to plan for this. You may need to manage your $500,000 cap to optimise your contribution, but your accountant can determine if you have sufficient taxable income to take advantage of the change. But they also need to consider how other areas of the tax law might apply, such as extra tax on super contributions for high income earners.
So high income earners won't qualify?
Where their balance is under $500,000, they can still qualify, but the scenario is that they may not, just by virtue of the amount of contributions that have gone in, they may not qualify under this.
How similar or different is this to salary sacrifice?
The salary sacrifice is an agreement that you have with your employer where you basically forego some of your salary and you're asking your employer to directly contribute that amount to superannuation for you. In that instance, you're still limited by the contribution cap for the current year, whereas in this scenario here, you're able to contribute yourself and control that yourself and look back at those previous years and determine what unused portion you have for yourself.
So if you think you might fall into this category, what's the first step you should take?
Well, I think if you think you're going to fall into this category, it's definitely worth getting in contact with your accountant or your advisor because they can help check whether you actually are eligible for it and check all the other factors like whether your total super balance is under the $500,000 mark, because they're sort of the two important things that need to be considered before going into this strategy.
That was Joel Orbita, Senior Manager at Mazars. This episode of Business Essentials Daily is produced by the team at Sound Cartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. Sound Cartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.